Welcome to the Ellsworth Advisors monthly update for the month of August. I'm Kelly Keenan, this is my partner Cameron Mealy, and today we'll kind of run through what happened in the markets and the economy for the month of August and year to date. Also talk a little bit about the portfolios, what's been working, what hasn't been working, and a little insight as to what we're expecting over the next 30, 60 days or so. And to start off, I'm going to have Cameron give us an economic update here.
Thank you, Kelly. Not surprising, I think we're going to hit on some topics that we always seem to hit on, and that'd be GDP, corporate profits, and expectations for GDP. So if you look according to the Bureau of Economic Analysis, the second quarter GDP loss was revised down to a loss of 31.7% annualized loss. So that's a little bit better than what we saw in the initial report.
32.9?
But not much better.
Right.
So original loss estimate for second quarter GDP was 32.9%. It's been revised down to 31.7%. That'd be an actual loss of about 8% of gross domestic product over the second quarter. And so we keep talking about this theme of weak first quarter, really weak second quarter, businesses basically shutting down. What's the third quarter going to look like? Now, according to the Atlanta Fed and their GDP now model, they're expecting third quarter GDP to be up 28.9%. And so I think if you look, this is a dead cat bounce.
Yeah, they're really ones I was seeing is like 20%. 28, I hadn't seen that number yet.
This is as of August 28th, which is the most recent revision. But it's just amazing how you could see an economy, especially one the size of the U.S., go up, down, up, down. The volatility is really staggering. But what does this all mean? We essentially saw the economy stop in the second quarter. And so I thought that corporate profits would be down significantly, and they really haven't been. Corporate profits in the second quarter decreased at 11.1%, and that is after decreasing 12% in the first quarter. So saw very weak profits in the first quarter, very weak profits in the second quarter. Second quarter profits were down 20.1% on a year-over-year basis. Not surprising, but frankly, I thought it would have been worse. So what was keeping corporate profits going? Online sales.
There you go.
Yeah, it seems very intuitive. We were all at home, we all had extra cash, we weren't going out, and if you were like my family, we were on Amazon every day. So if you look, according to CNBC, consumers spent $211.5 billion in online sales during the second quarter, up 31.8% from the previous quarter. That's a significant step up from the first quarter, which saw U.S. e-commerce sales of $160.3 billion, an increase of only 2.4% from the fourth quarter. So everyone's at home, massive spending online. Boxes are showing up, boxes are shipping, propped up corporate profits. What I found most interesting over the last couple of weeks is the pivot now that the Fed seems to be taking in terms of inflation.
Right.
For years, historically, the Fed's mission was to control inflation. Really, it was full employment and managing inflation. And, in a response to these last 10 plus years where we've seen record low interest rates, record low unemployment, almost no inflation, the Fed has now, basically come back and pivoted and said they're going to allow inflation. They want to get back to, we cannot maintain these zero rates.
Right.
Inflation was often looked at, especially coming out of the oil shock in the Carter era years in the 70s. When you had hyperinflation, it was looked at as a huge destabilizing force for the U.S. economy. And now we're running at zero inflation. So the Fed's trying to find that right mix. Their historical target's been 2%, but it sounds like they're going to let the inflation fluctuate above 2%. Most pundits think, maybe 2.5, 2.75%. We're not going to have runaway inflation, but a little inflation is not a bad thing.
Yeah, the inflation thing, we've been kind of numb to it since the financial crisis. And historically, if you have more money in the system, that historically creates inflation. In 08, 09, the Fed created a lot of dollars, created a lot of money, and all that money went into the bulk of that money went into the banking system to basically shore up the banking system, which is why it was a financial crisis, because the banks were in bad shape. That money basically stayed in the banking system. We had the slow growth coming out of the financial crisis. Inflation never really reared its head. It was minimal, and the whole time the Fed was basically fighting deflation. Deflation is the death nail. If we have deflation, that's the biggest problem. You cannot there's no easy way to get out of deflation. It's just not a pretty picture. Inflation, from the governmental standpoint, if you have inflation, all this governmental debt we have, in real terms, actually becomes smaller because it becomes worth less. So, yeah, the government wants deflation because now our debt is worth less, and that's good. Okay, but a lot of inflation is a problem because prices are rising, and unless wages are rising, commensurately, it's a bad thing. And also, inflation makes if you're holding bonds, holding cash, that makes it worth less.
But you think is modern economic theory correct?
Well, here's what I think the difference is going to be between 08, 09 and now. So we just created about $2 trillion in stimulus. Mm-hmm. That money didn't go into right to the banks on the bank balance sheets. That went to consumers and businesses. A little different than last time around. The intention the first time around was give it to the banks will lend it out. They never did. Now it's going directly to the consumers and the businesses. But if consumers and businesses have more dollars available, they spend more, which drives inflation. Unless you're in the middle of a pandemic and everybody's staying in the house. Yeah, they're doing online buying, but there's no travel. Mm-hmm. And all of a sudden the savings rate jumps up to 20%. My fear now is that, okay, demand is down, supply is definitely constrained. Yep. The other morning, Max is in the office, he's out trying to buy appliances, and unless the appliance is on the floor at Best Buy, you're waiting months to get what you want. So now consumers have all this money, they can't really spend it right now. At some point, as things open up here, I think spending is going to ramp up. I think there's more inflation. And that'll bring your inflation coming down the pipe. Okay. Where that goes to is hard to say, but inflation is definitely on our minds from an investment standpoint. And when you look at we need inflation to get returns. Yeah, we need it. And when you look at how do you get returns in inflation? Like you said, two things don't work with higher inflation: is cash loses value, and low interest rate bonds fixed income lose value. So we've minimized our exposure there. We have to have what we have. But from what are inflationary assets, things you want to hold in inflation, one is stocks. Over time, now in the short term, stocks will get hurt by inflation, but long term, companies will grow and basically they'll inflate with inflation. Yep. Commodities, those are hard assets. They'll inflate with inflation. Gold, I think this time around, gold's going to work. It's a commodity, and ultimately, I think real estate will work. And that's something we've been looking at. When's a good entry point into real estate? I'm still a little concerned about, just from where the economy is. And we could have a lot of physical space. It's never going to be needed again. I need a little bit more shake out there before start buying in real estate. But we'll start taking a position in real estate again in the not too distant future, and inflation bonds. So those are the things that we're kind of starting to tee up, because I think inflation is going to be coming down the pipe. We want equities for that long-term growth. We need some shorter-term things to fight the inflation that we're starting to build in the portfolios. And on the fixed income and cash side, that's for safety. That's kind of how we're positioning things, and we're starting to see things change. The fact that the Fed's going to let inflation run, that's also, I think, code for we're not going to raise interest rates. So we're going to be running into some interesting times here in the next 6, 12, 18 months. I think we're going to start seeing some of these things play out. But you think we ever get back to, or anytime soon, the 5%, 6% interest rate environment? I mean, it did take a lot. Those are huge moves, going from 0.7 on the 10-year to 5%. It could take a long time. I mean, someday I think, we probably will be there at some point. And it's just a matter of how soon or when. Okay. What other kind of data points did you have on there, or was those the main things? Yeah, those are the main things. Yeah, inflation, like you said, Cam kind of jumped on that. I don't think that's a right now issue, but it's coming close. I mean, that's going to be something, like I said, we're thinking about it already, start to position for it. You're starting to hear a lot more talk about it. What's fascinating about it is we've had a Fed that has dedicated the last 50 years to fighting inflation. All of a sudden saying, maybe inflation isn't a bad thing, we need inflation. There's a lot of things are changing. And come November, things may change again. So we'll see. Let's jump into what's happened in the last month. Let's see what happened in our portfolios. We'll dovetail into that and go from there. So last month was a good month across the board. August was a great month, not typical for August. But obviously we're coming out of a strange time too. As things are improving. So the Dow in August was up 7.57%. So, kind of made up some ground. It's been lagging. Year to date, still down 0.38%. So like I said, the Dow's made up some good ground. S&P 500 for the month was up 7%. So it's been a while since we've seen the Dow actually outperform the S&P. Year to date, the S&P is now up 8.34%, all-time highs. Last week, things were just running. But that also shows, the Dow's down 0.38, S&P up 8.34. That shows the dynamic that the composition of those indexes is different, and you have basically 6 stocks that are accounting for a lot of that return in the S&P 500. Those six stocks are technology-oriented. You have Facebook, Amazon, Apple,
Tesla.
Well, Tesla's not really
Okay.
in there. They just entered the S&P for how, whatever that means. What do we say? Facebook, Amazon, Apple, Netflix, Google, and Microsoft. Those are kind of the big 6 that are driving everything. And there's definitely a theme there. It's all online oriented.
I mean, but they're literally pulling that index with them.
Correct. They're dragging the index up. That's why you see that big difference because, in the Dow, Apple's in there, but it's not as heavily weighted.
Right.
So you don't have as much tech exposure in Dow. Dow's more industrial oriented. So everything was up in August. The industrials, tech was up the most. Industrials were the laggards. Everything else in between was up. So we're seeing participation, but you're definitely seeing some outperformance in that tech area. Big concern of mine is, in those tech stocks, valuations are getting very rich. They're getting to be very expensive stocks. You're paying a lot of money for $1 of earnings, whether that's $80 or $100 for $1 of earnings or $200 of earnings. They're getting expensive, and
It's
to see that split.
Even if there's money propping everything up, it's hard to justify paying $500 for $1 of earnings.
Correct, and that's the issue we're looking at. We've seen this before in the late '90s, in the dot-com bust, and at some point there will be a day of reckoning. We have a little bit of exposure there, but we're very conscious of that exposure. What we're really focusing on are little better valuations. I wouldn't call it a value play, but really it's more, hey, we want stocks that are growing their earnings, but we also want reasonable valuations. Is really how we're approaching our equity selections. So that's where we're seeing this split in the market, and we have to be very conscious of that. Outside of large cap stocks, which the Dow and S&P represent, small cap stocks for the month were up about 5.5%. Year to date, they're still down about 6%. We've seen international markets pick up some steam. Last month, the MSCI EAFE was up 4.93%. For the month, still down 6.23. So international still lag, but like I said, they're making up some ground. Emerging markets last month only up 2.09%, which was a little surprising. Typically, if things are hot here, those kind of run a little bit. They're only down 1.18 for the year. So that's kind of what's happening internationally versus domestically. In our portfolios,
So basically, it's been a flat year.
For
by and
emerging
large.
markets, basically. The developed world has a little bit of ways to go. Valuations seem a little bit more reasonable internationally. There's thoughts there, maybe increasing our international exposure and the growth with income, but I'm not quite there yet. From a portfolio standpoint, our growth with income portfolio, which is more of our balanced portfolio, great month last month, up 3.72%. Year to date, up almost 8.5%. So we're right in that 8% range for most accounts for the growth with income. Big winners for the month: NVIDIA up 26%, Apple up 22.66%, Pepsi up 14.8%, Berkshire Hathaway up 12%, Visa up 11.5%. The losers for the month: Cisco came in with some bad earnings and just some things happening there. So that's down 10.36%. It's gained, it was down a little bit more. It's gained a little bit. Digital Realty, which is our, one of our real estate plays, they own server farms basically.
Which is a great space.
Tech running, a little bit of pullback in real estate, down 3.05%. And then gold. Gold's been working for us all year. We gave up, 0.32%. So gold was kind of a flat month for gold. So you can kind of see, definitely what's worked last month. Like I say, it was a good month. Losers, I'm sorry. We talked about the losers. Year to date, obviously Apple up 77%, NVIDIA up 127%, gold's up 29%. Our international funds up 13. What's been bad for the year to date? Disney down 8.82%. No surprise. Cisco down 9.8. Obviously, that all came last month. CVS down 14.45. That's a little surprising, just with all the activity they're getting, testing and so forth. But we still think it's a good long-term hold. Price potential last month 3.97. So kind of lagged, and that's because we don't have a lot of that exposure in those tech areas in the price potential right now. Year to date, we're still down about 3%. So disappointing there. We're not changing the strategy. I think it is going to play out, but we just need to be patient inside price potential. Last month, Genpack up 5.93%. Alamo Group, not the car, not the car company, up 7.56%. Edwards Life Sciences up 9.48%. Costco, Merck, Republic Services Group all up over 6%. So the only loser last month was IHS Markets, which is actually online data service, down 1%. Kind of interesting there. Dividend yield, nice month there, up 4%, so that made up some ground. Still down about 4% year to date. Big winners through the month: UPS up 15.34, McDonald's up 10.55, Eaton Corp 10.42, Caterpillar 7.1. So we're seeing some life in the industrials there. Con Ed was down, from a loser standpoint last month, down 6%. Pfizer down 1.79%. Another utility down a little bit, 3.31%. So, year to date, UPS is up 43%. LyondellBasell, which felt a lot of pain through the height of the COVID stuff, actually up 16% year to date. And I was really concerned about that holding, and definitely turned it around. I'm glad I stuck with it. Eaton's up 10.69. McDonald's looks like it's up about 10%. So that's kind of where we're at in dividend yield. SMID,
which is our small cap portfolio.
Our small cap portfolio. Last month, with the small caps, we get some crazy swings. iRhythm Technologies, 78.88. That's exciting. Red Violet, 35.4% or 35.8%. Kodiak Sciences, 26.3%. Solar Edge up 22%. Amphastar Pharmaceuticals up 20%. So big winners there. But then again, OneSpan down 30%. Zynex, which we're up in there still year to date, but that was down 22%. EverQuote down 34.8%. So once again, big swings. For the month, that portfolio is up 4.47%. Year to date, we're down about 1%. So that small cap is definitely outperforming the index. And I like kind of the momentum that's rolling in there, and that's been a good place. And also from a diversification standpoint, I think we're going to continue to see some strength in small caps. They're not going to be exposed to potential weakness in those mega cap stocks on the NASDAQ side. So that's kind of where we stand right now. Like I said, with our more value, or call it quality-oriented stocks, we've made nice gains. We're still lagging a bit, but I really think it's because we're staying away from where I feel the high-risk stocks are. I'm not because of flashbacks to the late 90s, early 2000s. With what we're seeing in the market, I'm just don't want to be too heavy in those tech stocks.
And that's what we've always talked about.
That's kind of how we've had to work.
Yeah, participating on the upside, but balancing that with downside protection.
Right, exactly. In the short term, August was a good month. We had a good run here. Technicals, very short term, are definitely looking very extended, where overbought signals, we're way overbought right now, where the market is in general. We've seen the VIX start to spike up a little bit. There's been some unique options action which can account for that VIX increasing, but we're definitely poised for a little bit of a pullback here. We've been holding off on new money coming in with buying. We've been kind of real slow feeding in the last several weeks, sitting on a little bit of cash, waiting for a pullback. I think we're due to have one, in the very short term, in the next couple of weeks or so. The other elephant in the room is, we're less than
election
90 days
here.
out, 60 days out for the election.
Yep.
Yeah, that's going to be interesting. Been fielding a lot of calls around the election. Both concerns if Biden gets elected or if Trump gets reelected. I'm hearing it from both sides. And I think we've talked about this in the past.
Mostly based on political bias.
Yeah, and the reality is I think the election is going to be fairly neutral. There's pros and cons of either person being elected, but in the grand scheme of things, I don't think it really changes the dynamics, the market dynamics. I don't think it's really going to cause a big boost in the market or a big decline in the market. It's really going to depend on how are things progressing through, the COVID outlook, the trajectory of improvement in earnings, trajectory of improvement in the economy. Those are going to be the key drivers. And like I said, there's pros and cons of either person being elected. I truly believe no matter who's elected, the fiscal stimulus is going to keep on. It's going to keep on coming.
Keep the spigot going. Absolutely.
The spigot's going to keep. It's going to stay on. Hopefully we may get some resolution, maybe get some kind of infrastructure bill. There's talks on that coming down the pipe. Other than that, I think it's in Washington, it's going to be more business as usual. If Biden were elected, I think some of the media hype changes, which could actually provide more of an optimistic outlook. But if Trump gets reelected, maybe the shift goes away from COVID to contesting the election. I think that's a possibility. Which
second round of impeachment.
I'd say the most impactful thing on the economy is the COVID outlook, and if some of that media around that were to die down, I think you see more economic acceleration. And that's really what
frankly,
I'm looking for
unless one
election.
party has all three chambers, you're really going to have a tough time getting anything major done.
Correct.
Unless there's compromise. And right now, left doesn't want to compromise with right doesn't want to compromise with left. So, this could be kind of this typical situation where one party's got one office, one party's got two offices, and they're just kind of butting heads
And
for
I
the
think
next 4 years.
ultimately how
that's sometimes not bad for the stock market.
Correct. Yeah,
You
and
know,
I think
Washington
that
gets out of the way.
Yeah. I think ultimately that's how it plays out, and so I'm like I said, I'm not worried about who gets elected. It's really the trajectory of what's going on, and we know there's a lot of stimulus coming, which at some point we will pay that price. But in the short term, intermediate term, I think we're going to keep on chugging along. I doubt we've seen the highs for the year, but these next couple of months could be flatter or a little dicey. But I think there's some more advancement between now and the end of the year.
Yeah. And as always, if you have any questions, please don't hesitate to pick up the phone. Give us a call. We're always available. And hope you have a great day. And we'll talk to you next month.
Have a great Labor Day weekend. Thank you.
Thank you.